Hi, I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by founding partner and chief economist Don Rissmiller. Don, how are you doing this morning?
Very good, Ross. Good to talk with you.
Good to talk to you as well. Timely. We just had our first rate cut of 2025. I kind of just want to turn it over to you and ask what your big takeaway or maybe the most interesting thing you heard from the Fed's meeting in September.
Sure. So it was an interesting meeting. The Fed did follow through with what was expected of them. They cut rates 25 basis points. If you look at the forecasts in the dot plot, you could construe those as dovish, but if you listen to Fed Chair Powell in the press conference that he gave, you could construe that as hawkish. So I think we have an FOMC that has re-engaged with a rate cut cycle. They did what they needed to do at this meeting. The October meeting is certainly live. The December meeting is certainly live. You can make a case for the FOMC to vote for two more rate cuts this year. But what they want to do over the next several meetings going into 2026 is to try to get the Fed funds rate to a neutral setting. There's a belief that it is still restrictive, and that is not needed. So you don't need a Fed funds rate that's doing much to the economy at all. You don't want it to be restrictive, and you don't really need it to be stimulative either. So I think over the next several quarters, they'll likely continue to lower rates, moving to a more neutral policy setting. And as we get to next year, we'll have different FOMC members, and we can assess how they'll treat the situation.
So, they're obviously in a cutting mode because of perceived weakness in the labor market. Some of the data has been pretty dour, but the overall economy and spending picture has been okay. And you've written about two kind of separate phenomenons that I want to ask you about and potentially kind of barbelling at different ends of the income cohort in this country, which is the wealth effect and the gig economy. Could you talk to how each of those two things are showing up in the data and how they might be impacting the overall spending picture?
Absolutely. And I think it is challenging to say what the US economy is doing right now because it's a very different experience if you're at the upper end of the income distribution versus if you're at the lower end of the income distribution. So if you own assets, if you're at the upper end of the income spectrum, things look quite good. You have stock markets that have worked in your favor, you have home prices that have risen. And so you're able to continue spending on trend. Now, at the lower end of the income distribution, there have been some pretty significant challenges. We could think about what's gone on in the credit card borrowing space. We could look at auto loan delinquencies. So there are some significant headwinds for that part of the economy. But the gig economy, which is often underestimated because the data isn't great, is a place where I think that cohort finds some support. So we have an extremely flexible labor market in the gig economy. This is the fractional jobs where you could work one day a week, even half a day a week if you wanted. And so they may not be the best jobs. You wouldn't get a pension. You don't get a 401k. You may not get health insurance. But if you need income right now and you have a phone and a car, you can probably give it a go. And there are a lot of available options. So the upper end of the income distribution relies on wealth effects, the stock market, asset appreciation. The lower end of the income distribution relies on the gig economy, and that creates a channel for consumer spending. And that's what we've seen. We have not had big variation in that sector.
Right, and that's important to consider when you're thinking about how much the Fed might end up cutting, say, by the end of next year. So I want to end with a question that I ask every time I talk to you. I think it's the most important thing over the next 5-10 years, which is the productivity story. We obviously have a severely limited labor force growth kind of potential in the US, both because of demographics and immigration. So the question of what the existing labor force can do as far as output is the big question. And the technology and the AI boom kind of fuels into that. What are you seeing on the productivity side of things? Are there any kind of green shoots that AI or technology is starting to have a positive impact there?
Yeah, this is a critical question because if we're not going to have more people or more hours worked, then we have to get more output per hour or output per person to grow. So productivity is the way out. This is a private sector phenomena. This isn't really a government-led phenomena, maybe a government-facilitated story, but it'll be the private sector that drives productivity. And we're seeing some early signs of productivity improvements within tech. So if you look at like computer manufacturing, you can see some evidence. But what we really need to see to impact the whole economy is a very broad story. So if you think back to the 1990s when we had a productivity boom, it was the tech companies and then the users of the technology who also saw gains. So that's what we have to watch. We should see a broadening of productivity to the users of something like AI or other technological advancements right here. Their profits should increase, their productivity should increase. And that's still an open question. I'd be optimistic, but that's something that AI has to deliver to really close the deal here.
Don, that makes a lot of sense. Thank you as always for the time and the insights, and we'll look forward to talking to you again soon.
Great. Thanks, Ross.